Some discussions may touch on legal and tax topics, but nothing contained in these episodes should be considered tax or legal advice. David and I are not accountants nor licensed attorneys. Please consult with your tax and legal professionals for advice on your own unique situations. Well, guys, welcome to the Did It Close podcast. Host Bryan McCann and David Dirkschneider, and we're really excited today to be joined by Matt Rocco, who heads Colliers Mortgage. So, Matt, big thank you, and thanks for joining. So, tell us a little bit. It looks sunny where you're at, so tell us where you're sitting and a little bit about yourself. So
it is, yeah. Listen, first and foremost, Bryan, David, thank you so much for the time. So, very quickly, because this is the least interesting part of anything I'll say today, I hope, for the benefit of your guests. But I do run Colliers Mortgage, surrounded by a great team of professionals located throughout the country in 28 production offices, providing the holistic, comprehensive services and solutions of the broader Colliers International, but with focus on debt, equity, and structured finance vehicles, as well as some of our broker-dealer activities and the great we do with servicing and asset management. I am here in Charlotte, and I do live in Charlotte, but I have an office in Minneapolis where I do spend time, as well as the most important place I can be is where my clients, those part of Colliers Mortgage or throughout the Colliers network, need me to be in front of clients, providing backdrops or information about market conditions or just perspectives on markets.
And Matt, how'd you wind up? I guess kind of the road to Colliers Mortgage. Like, what was your backstory? How'd you get started in finance, and what was the road that led you to where you are today? So.
It's a very boring story, so I'll make it quick. I was very fortunate to be surrounded by just great people. They were thought leaders. They were practitioners in the business, as well as owners of businesses and just industry executives. And I knew from an early age that the capital markets business associated with commercial real estate was very attractive. In fact, over time, I moved into the valuation part of it, wanting to understand the appraisal side, because valuations oftentimes dictate market transactions and investor interest, and then expanded that further into investment banking and asset management. I guess we were a real estate hedge fund before today's real estate hedge funds existed, taking advantage of market disintermediation and activities that some of the more highly regulated groups at the time were unable to or unwilling to participate in. So it was a great learning curve. I met some fabulous people in the mortgage banking and mortgage real estate investment banking business. And they said, hey, Matthew, you have an opportunity to work for some great companies in this industry to distribute a comprehensive set of services and solutions to those clients and not be beholden to an individual credit strategy, a hold position, or any prejudice that they might have on asset types or markets. In fact, I saw that as liberating at the time as a capital distribution and servicing agent to provide that full perspective of value to the clients. I've been doing it in mortgage and investment banking now, this side of it, away from the corporate investment banking side. This is my 26th year. Love doing it every day, surrounded by outstanding people. And now moving into my third year at Colliers, looked upon to build upon the success I've had for decades.
And I later on in the episode, I want to circle back because I know I've gotten to know you a little bit just in our kind of our conversations, but I think what speaks to me more is, not only are you just very intelligent on the mortgage side, but your leadership is actually, so I kind of want to dive into some of the leadership things. And I know David Dirkschneider has a background in Marine Corps. So I know leadership is near and dear to his heart as well. So I think kind of we'll circle back to that, because I think some of the things that you've set up and the way you've empowered your people is really, really interesting. I think there's a lot to learn from. I guess to kind of start for, and I think the audience, comes from a wide variety. Some are very, very familiar with capital markets and EDSF. Some people might not even know what EDSF stands for. Could you give us a little primer on, in commercial real estate today, what is EDSF? What is the different types of, debt products that are out there, and kind of just a high level overview so that we can kind of normalize that we're all speaking the same language.
It's interesting because even when you get into that question, you need to delve further into the types of assets for which we're talking about, because there's many economies in the marketplace today. There's a Wall Street economy, there's an equity economy, a debenture economy, and a real estate economy. And within the real estate economy, that's really where we do focus, those hard assets, real assets. And they include office, retail, industrial, apartments, but within apartments, seniors housing, affordable housing, structured finance. Um, it is, however, though, an interesting time in the marketplace. As an asset class, commercial real estate is a levered play. Quite frankly, generating returns while attracting investor capital to participate in those same opportunity returns from not just across the country, but across the world. In fact, I see commercial real estate today as an asset class as a critical diversifier to other fixed income or alternate fixed income investment strategies. So commercial real estate, by and large and by definition, tends to be a liquid, capital intensive, and management intensive, but it is tax favored. It is a levered business, so equity into those deals can generate a very strong ROA and ROI accordingly, while at the same time, being an important diversifier gives people, if you will, a balance to a different kind of portfolio. Bryan and David, when we grew up in the business, it was usually the matriarchs or patriarchs or small family offices that owned the vast majority of commercial real estate assets in the middle market space throughout this country. However, we've seen that change dramatically post GFC. So really in the last 15 years, we've seen the advent of private capital, of development equity funds, of general partnerships being formed, of DBAs and business development corps, for example, with a focus on commercial real estate and other real assets, but particularly wanting to expand their reach into those same assets. So we've almost become institutionalized in some respects, and I'm talking about the middle market and above. And the capital services that we provide would include your traditional first mortgage, but now that's migrating into, in today's environment, we need a little bit more juice, so that it could include mezzanine, preferred equity, or structured equity. In fact, I'll even submit to you that some of the words out there get silly, but I would coin something called dequity today, which is a hybrid, almost an equity and debt position, sometimes structured as a participating mortgage. So within that space, in representing a myriad of capital partners we call correspondents or investment partners, we deploy that capital for the benefit of those same partners of capital. We service and asset manage many of the loans that we originate, and in doing so, we holistically look at what that debt does to the equity position, the associated return, the ownership objective, financing objective, as well as the investment horizon of those same investors. We match them closely with investment professionals like yourself at Colliers to ensure that if we're not there just to provide the debt, equity, and structured finance, we can provide evaluation, oftentimes the property management, property support, or logistics support facilities included, as well as the investment sales. And we think that's a powerful combination as a go-to-market strategy, which positively differentiates us from many others in the space for which we play.
Wow, I'm going to save that for my next pitch. That's very well said.
Not my first rodeo. I've been doing it a long time, but I do believe it, David. It is a very interesting business. And when I started in the investment banking space with a very large part in partnership of an investment banking firm, real estate was truly seen as secondary. It was not the primary asset. It was the debt and the deployment of that same debt, and at times equity, that could achieve scalable returns. It did change after tax reform in '86, and then long-term capital, their failure in 1998, a Russian bond crisis, some other things. And then we had the dot-com and then lead up to the GFC. But I think those experiences in the market created a more sophisticated, a more centralized class of real estate today. In fact, adding real estate to the S&P 500 just about 6-7 years ago added actually a different level of investor interest to the space. And I see that only continuing to grow as we look at the equity markets today, or alternate fixed income investments, private capital included, including PEGs and other investment vehicles. Capital formation is very strong. And as a diversified asset class, again, many economies in commercial real estate, Colliers and true our competitors got can provide access to those same investors that can generate alpha returns.
When
God,
you
David.
say into the market, you talk about when they to put REITs on the market, or what were you referring to specifically?
The REIT space is important. It is a space that we represent both on our broker dealer space and providing capital to in capital services to the REIT sector, advisory work included, and on our debt equity and structured finance team, we do advise REITs. But REITs are a de minimis part of what I'll call the investment portfolio for which we represent. David, if you look at the gallery of investors, public REITs, which now and by and large historically have traded just below NAV, well attractive, they operate more like real estate utilities. And those real estate utilities are important for some investors in diversification, but they don't offer some of the same benefits that direct or slightly indirect through fund management investments in real estate do. So while we do love working with the REITs, it's a small part of our practice. And by and large, I see the growing part of the space, if you will, in the REITs need to be included, but is separate and distinct from some of the private activities that exist in both the direct and what I'll call investor direct investments in commercial real estate. I see that growing faster than the REIT class itself.
I guess what I meant is you had said something about when it was added to the market, I think 7 years ago. So you're talking about like CMBS, or like what were you talking about, like
the S&P? I apologize. Yeah, the S&P I'll say 7 years ago. I could ask my research theory in Google to look it up. But it was actually added about 10 years ago, but then came to the forefront of investors for diversification, just looking for yield, an alternate yield. There was exposure that had, if you will, more durability, positive convexity, and it was more attractive to investors as capital aggregators. And there really are, the names, and it's Blackstone and Ares and Apollo and Carlyle. And that's different today than it was even 10 years ago, because those capital aggregators are a force, an investor force that is somewhat new to the marketplace. But again, it works in concert with the banking industry. It works in concert with the REIT industry, David. But it also employs even now retail investors, and the qualification standard is accredited real estate investor or qualified real estate investor. But that doesn't mean really your most sophisticated investor classes. So they've created associated funds, ETFs, and whatever. And I believe we're just at the forefront, particularly at the retail space, where equity, if you will, REITs, we're always in that space, offering investors avenues and opportunities to engage, if you will, entry points to that. I see that now coming in a different fund structure, which probably means we'll see those capital aggregators continue to innovate and sell products that derive some of their asset values from commercial real estate.
I think I think I just read an article even this morning where like isn't Amazon or Bezos is kind of like he's trying to make like retail single family home investment. And it seems like as you're trying to move it more into that to attract retail capital that can be aggregated and then kind of, be placed more into the institutional space.
That's kind correct. Yes.
Yeah.
Which is kind of scary. I mean, we need more money driving the yields down even further, and then you get all that. I mean, it's good and bad. Don't get me wrong, because then just the average investor can get involved. But I mean, that's all we need is even more liquidity in the market and driving.
David, you brought up something that I was just talking about with some associates in the office this morning. We do need to be careful about those highly correlated trades. Highly correlated trades, or crowded trades, if you will, in the equity space creates, if you will, correlated risks. And if we look at the private credit space today, can you imagine 5 years ago thinking that Blackstone would be the largest owner of marinas in the world? Okay, it's an asset class, I get it. It's great self-storage for boats, if you will, but products and services. Now we hear that the likes of Blackstone, Apollo, Carlyle, Ares, and others own sports teams internationally and domestically. They're the largest owner of dental clinics in the world, the largest owner of veterinary clinics in the world. In fact, I just read a PEG today was investing in honey bear. Yes, those honey bears that you keep, on your dinner table that you'd put on a biscuit or something to that effect. So all of this, I think is an avenue, to your point, David, an entry point, another way for investors to look for, if you will, attractive returns or entry points to alternate, if you will, equity exposure that they might have or debt exposure through bond markets or municipals, for example. But one does need to be careful. As David pointed out, Bryan, it is when that trade becomes so crowded and when the investors, like just coming out of the COVID cycle, if I could, when interest rates are zero, there are no cycles and everybody looks good. Cap rates drop precipitously and everybody thought it would last forever. And now we're back to the old normal. An old normal, although volatile, trading range in the Treasury, where the Fed funds rate, you should kind of have it around 4% over the next 12 months or so. And it could be described too as some of those assets still in the $5.2 trillion commercial real estate ecosystem, if you will, are impaired. Not all distressed, but many of them stressed. So I would characterize much of the real estate economy today, besides the most, if you will, sought after and liquid, high quality multifamily industrial assets, as well as some special purpose, but largely being in an organized bear market. And I say that, David, the good news is it's an organized market and not a disorganized market. As we know, liquidity supports value, and value is what drives investors to the space. And if we can remove some of the volatility, if we were, if you will, for example, in watching Bloomberg today, stay away from tariff diplomacy in commercial real estate or threats to the marketplace on a broader sense that might drive down other markets in commercial real estate, we should be pretty well suited for recovery if you're an investor, if you will, more recently in the last 12 months or before the run up from 2020 to 2022.
Sorry, Dave, go ahead.
I'm curious. So you brought it up to something I wanted to talk about anyways. You read all these headlines about the distress in the market and, and I'm getting calls almost on a daily basis of, hey, where are the foreclosures at? Where are these deals we're reading about? And I know back in 2009 and 10, there was a phrase, extend and pretend, and that seems to have kind of come around again. At what point do you start to see foreclosures and, more distress? Because you hear about it. I mean, I talk to a lot of owners and kind of hear about it indirectly as well, but you don't see it on the market.
And don't quote me on the date, but I think it's right. On about June 30th, 2023, the FDIC, the OCC, and the SEC came out with guidance, which actually was a takeoff of TARP and TALF post GFC, that encouraged banks to what I'll call almost deserving qualified owners, operators of assets, to allow to be able to extend credit. So we weren't going to force maturities, if you will, force defaults for the rapid decompression that we saw in the commercial real estate marketplace caused by 500 basis points in short-term rates. Many of those deals, in fact, floating, oftentimes with, at the time, an interest rate cap in place, but that cap soon to expire could have created some real financial carnage in the space. I think that was the appropriate guidance for different reasons post GFC. The primary reason is, David, this was an equity infused recovery versus a financially engineered marketplace pre GFC. So there really was a lot of equity at stake here. So while these loans, as I stated earlier, could be, qualified as a TDR or distressed because they're breaches to covenant, they're actually just stressed because they're closer to a 1.0, a 110 debt coverage ratio.
But they're still covering this.
They're still covering, but we got to be careful, David. It's a barely cover too. And some of those deals, in fact, I would submit to you, most of those deals were invested in, delivered, kind of from the 2019 to about the 2022 year-end time mark. And that equity is impaired, but you may still be close to parity with the UPB. That's why you've not seen, David, that push to let's just exit this marketplace. Let's sell notes in mass. Let's move these assets to the market. Transactional velocity, in fact, in the commercial real estate space, as you know, has been just remarkably muted the last few years, but it is because of the kick the can. I do believe an inflection point is upon us. May of last year represented the first anniversary of the 3-year interest rate cap. So those then expire. Cap's still very expensive today. And all of a sudden, investors are saying, hey, David, I've been in this deal for now, 4 years? My equity's impaired. Do I want to stay in this deal, or should I rotate out of this year and get a near cash return of close to 5%? Quite frankly, you can buy commercial paper close to 6%. You can get a triple B for low fives. I want something more liquid. This isn't what I signed up for. So I do believe, to David's point earlier, Bryan, better defining who should be in commercial real estate as an investor is important. I'm not sure some of the fund aggregation or capital aggregation through ETFs and retail investors is the right solution for that. Although it does offer exposure, the risk is that they're not fully understanding the redemption clauses, the payout clauses, and how long they're truly invested. I do think we'll have to work through this over time, but I don't believe it will otherwise take us off course from this industry continuing to grow. But that truly is the reason why we haven't seen these mass exoduses of loan sales or portfolio sales. I do believe, as I stated with last year, the expiration of the 3-year interest rate cap, that right now, even in a deregulated economy, which I expect to continue with the current administration, there's still investors who will, say, we need out. We want to tap out. We want to get into another asset class. So, Bryan, I think my deal is worth $10. You think it's worth $8. I'll sell it to you for $8, but give me a blue sky certificate for $2. After an appropriate time and waterfall, I can be paid out, but at least I have a liquidity event today.
You've said so many good things here, and I think and I have a decent understanding, but even some of this stuff probably was over my head. But I guess just to back up a couple things you said, maybe kind of define is, kind of going back to EDSF, right? Equity, debt, and structured finance. I think most of us know just from buying a house what equity is, right? It's our down payment that we bring. Debt, right? When you say structured finance, can you help define that for some of the listeners of how you would define structured finance?
Certainly. From the top, structured finance is generally the combination of a first mortgage lien with some form of equity or preferred equity or mezzanine financing, usually to gin up a transaction to limit, if you will, the equity, if you will, common equity requirement from other investors. That what we're finding in the debt space today, and by the way, and Bryan noted this earlier, concerns about where we are in the cycle and will this be different than past cycles. As I stated, this is an equity-infused recovery post-GFC, but in fact, it is still interesting to note that equity, some of it's patient and some of it needs to rotate out, but that equity that wants to stay in is something that we can rely upon. But what it did was allow banks to maintain what I think is an appropriate credit paradigm. So if you will, Bryan, post GFC, most first mortgages were limited to a 125 debt cover ratio. And I won't even go to loan to value because cap rates fell precipitously when interest rates went to zero. But sometimes there's actually, 30, 35, even 40% equity in these deals as a byproduct of those low cap rates. So we've seen, I'll call it discipline in the credit space. So first mortgages, call it, 55 to maybe up to 70% for high quality assets. And then it's that structured finance, mezzanine, preferred equity, or structured equity or equity levels that come in above that to gin up the ROI for investors. It is something, however, though, that is not for the faint of heart. I always caution real estate investors, to understand the dynamics and how liquid, how capital intensive, management intensive it is, and leave aside, if you will, past history of tremendous success and long-term returns that beat equity and even debt markets, usually by 2x plus. But instead focus on, is this the right investment for yourself, your company, your family, and is your investment horizon appropriately, if you will, set to manage through ups and downs in the cycle? So it's really that part of the space where we're not just debt, equity, and structured finance. We're really more financial advisors because we can arrange it all in a 360 comprehensive solution.
And What do you see? I guess we talked about like different players coming into the market, which has driven yields down, right? The advent of the retail investor, and the debt funds on Wall Street. What do you see kind of as what is the next play, right? In the sense of like, where could more money move in, which is going to drive yields even further down, or where does money start exiting, which obviously could cause a run? Like, where do you see those levers being pulled in the near future? So
I think since the Fed did move as high as they did, the 525 basis points in really very short period of time, it wasn't the rate that changed as much as the rate of change that caught investors sideways. I don't think they had the appropriate time horizon, but I think we've seen a lot of capital aggregation and capital formation around what David talked about earlier, the distress space, Bryan. So it's sitting on the sidelines, dry powder. Let's go in and buy notes, subperforming notes. Let's get in and buy them at loss severity, sometimes of 30, 40, 50%. And let's make our hay there, if you will, restructure and create a vehicle, both a scratch and dent or re-CMBS or re-securitization or reissuance of those same private placement activity bonds or whatever they are. So I do think that there's capital there, but Bryan, more specifically to your question, I think we're getting back to the old normal. Investors that do understand the dynamics of it, I think they'll look for opportunities in quality multifamily, quality industrial, quality MOB, quality self-storage. I think they're going to get back to some of the fundamentals of blocking and tackling in the space and take advantage of, cap rates moving up 150 basis points or more for certain asset classes. I think that's where it comes from, and I think that's what's healthiest for the marketplace.
A side question, don't want to derail it too much, but working on a note deal right now, what would you say, because you've probably done a lot of this, is kind of the typical value for a distressed note? And I know that's a loaded question because it can depend on a lot of things, but just in general.
Yeah, it's a double barrel shotgun loaded, no doubt about it. I think they're both buckshots too, but here we go. Generally speaking, the note buyers, if you will, they tend to be very sophisticated, and they tend to be fund structures that buy those notes, oftentimes for a whole host of reasons, including not wanting to take title to an asset because you then would assume ownership liabilities. So in that vein, David, if you will, I see the immediate discount, even at an appropriately priced loan that would mean an attractive interest rate to current market conditions or prevailing rates. At good leverage, not, if you will, impaired by asset quality or physical or market issues or whatever, trading at 90 cents. And then for those where you have an interest rate, if you will, that, hey, listen, good news for them, they locked it up, Bryan. Bad news for them, they only have 24 months left on that note, but they're at 4%. They're going to adjust to 5.5%. What does that mean? That kind of gets into the mid 80s. And then you get to the structural impairments, which include, I'm an office building. I'm not a class A office building. I'm a class A minus even. Maybe even a B plus, or God forbid, you're worse than that. I'm in a space of multifamily, for example, where there was 200% demand, but 500% supply of new quality multifamily units developed in the last 24 months. And all my investors are doctors, lawyers, or small-term investors that need to rotate their capital and they want out. Oh, and by the way, I only have 24 months left on my fund life. So you'll see those come in then to the low 80s. And then you get into true like tenant impairment, physical conditions, whatever.
Distress.
David, loss severities, just for the interest rate volatility, for the investor interest, let's just average that all out to say, 15 to 20%. And then when you get into those more structural features, financially speaking, if you will, you could be starting at 30 to 50%. And we've seen some notable trades. But I would submit to you, most of those notable trades are deals that really deserve to be traded at that level. Now, they got a good deal on them, no doubt. But when you see assets there's office trades in the Midwest, out west in California, you've seen in Texas, Houston, for example, San Francisco, LA, Minneapolis, I'm trying to think, Kansas City, I saw a big sale. In DC, get ready, there'll be more of those. Those really should sell for, 30, 40 cents on the dollar because particularly in the office space, going to the office economy in CRE, I jokingly have said for the last 20 years, it wasn't overbuilt, it was under destroyed. And some of those deals are truly only worth land value plus you have to take off the cost to deconstruct and then the environmental contaminants.
Yeah, no, that's a really good point.
I love that saying. I think that's going to be my new line. It wasn't overbuilt, it was under destroyed. I love that.
You can have it. We had this, interestingly enough, in like 2013 to 2018 with malls, with some retail. And now retail really is the darling. In fact, I see some of those dead malls as some of the best redevelopment opportunities in the marketplace. They're already commercially impacted. You can work with, if you will, a footprint or apron that should be attractive to mixed use development. And you can get it at a really good basis.
They're usually decent locations too.
They are.
Yeah.
That's right.
Yeah. I guess kind of to make a move. I know we talked a lot about kind of like the EDS. I'm kind of just diving in just the so probably what most people are familiar with, permanent debt structure, right? Kind of like down the middle. And I know, when we go out with a multifamily, we usually go out with, kind of 4 quotes, right? Agency, Life Co, CMBS, regional bank, right? That's kind of the norm of the matrix that you see. Could you kind of touch on those and maybe for some of the listeners, and I know you have some familiarity with this, what is, agency? What does that mean? What do they look at as compared to a CMBS or Life Co? I think most people are aware of regional banks, but kind of just touching on the differences there.
So here we go. Hit with the GSEs. The GSEs are different today than they were pre-GFC. They entered something called conservatorship. Conservatorship now, FHFA is their regulator, their conservator, if you will. And their job is to not be a lender, but instead through the likes of Colliers, provide liquidity to our ability to create securities that then they wrap for simplification purposes and sell to the secondary market with a credit guarantee from the government, if you will. I won't get into expressed or implied, but just go with it and assume it's implied squared. We'll leave it at that. But they do that not just for the multifamily space, but also the single family space. In fact, without the GSEs, the single family market would be a fraction of what it is today. In fact, the non-callable 30-year fixed rate mortgage in single family is the hallmark of housing stability in this country. What's interesting, though, on the commercial multifamily side, where the agencies do play, they play where others don't, Bryan. So you mentioned insurance companies, pension funds, community banks, regional, and even GSIB banks, but they don't love doing deep affordable housing. They don't love getting into the senior space or the high acuity space in seniors, including memory care. So thank goodness we have Fannie, Freddie, and FHA, HUD, to provide those liquidity instruments or credit enhancements so lenders like Colliers can go to the market, create these opportunities for the GSEs to wrap in securities with us and sell to those investors in the secondary market. Think of it like a treasury guaranteed with an extra kicker in it. So the dynamics are actually quite attractive in the agency space today. Both agencies on just the multifamily side are capped at $73 billion each. That's ample room to absorb what they forecast the supply to be in 2025. That's up from 70 respectively last year, which is up from a little bit before that over time. But I would also submit to you, though, that I do believe the FHFA stands at the ready, if needed, to ensure liquidity to the marketplace, that they would expand those caps if needed. Now, they're going through an interesting point today. There's a lot going on in D.C., including discussion of agency reform. Be happy to touch on that at a high level. But at this time, they're a critical part of the commercial real estate marketplace, and then they're the dominant force in the single family marketplace. In the insurance company space, insurance companies have always loved commercial real estate. In fact, insurance companies were the largest investors on the debt side, if you will, and a portion on the equity side in office buildings. In fact, it was very efficient, allowed to get large amounts of capital out in deals all across the country, but think of your major CBDs. and everybody went to work. There was no hybrid, there was no work from home and what have you, and they were predictable, identifiable, and generally had long-term leases. That's since changed. And then you go down to, the CMBS, and that's an execution created in part, and I'm friends with the guys who all professed to me that they were the single source of creation for that. I think they're all actually deserving of the credit, and I'm friends with them, but they provided a liquidity vehicle post something called the Resolution Trust Corporation after tax reform in 1986 and some other things to work through a whole host of, as David pointed out earlier, what do you do with these defaulted loans? You kind of create a REMIC, a real estate mortgage investment conduit. And in doing so, you create liquidity, and liquidity supports value. It is a trade less than it is a marketplace, but they are critical to provide liquidity to some of those assets that banks, insurance companies, and the agencies don't provide financing for. Think of hospitality by and large. CMBS is a dominant player there, but they also lean in with some structure, including interest only, sometimes higher leverage, because they mandate that these loans be fully reserved and escrowed and things of that nature. And then there's a very, very large transactions. Think of 500 million or more, where there's a single asset, single borrower, or otherwise SASB providing liquidity to that space. And that's very attractive to the banking community. The banking community, we could call them systematically important financial institutions, or GSIBs, globally important financial institutions. Those largest banks, think of your top 10 banks. They love the space they're in, but they actually have less of a book and hold strategy in originate to distribute than I've ever seen before. I'll go down to the regionals and super regionals, and while they still value the relationship with the customers, by and large, they want to bank their customers. They're not just leading with real estate. They're getting it from corporate banking, perhaps investment banking, perhaps insurance, depository, or other services. And then when we're down, if you will, to the small regionals, communities, and even small communities, that's really where they do have a book and hold strategy, because they provide auto loans, they provide lines of credit to investors, they're big into the SBA lending programs and single family lending programs, but their core asset, if you will, on their books tends to be commercial or residential real estate, sometimes car loans and ABS, but it's very important to them. And I want to give a shout out to those same banks, because without the liquidity that they provide, those super regionals, the SIFIs and GSIBs, they don't want to make $1 to $10 million loans to those same investors. So they are the lifeblood of what I'll call Main Street America. And I do have a concern, Bryan, if I could take it a step further, and I'm not going to point to administration, but over time, post-GFC, we really have seen banks become more like financial utilities, in part driven by regulation, because we never wanted it too big to fail again. Yet I'll submit to you, through first mergers and acquisitions, the GSIBs and SIFIs are larger than they ever were pre-GFC. That's for another day. But now by the investors. The investors today really don't want tall trees in a credit perspective in some of these same institutions. They would rather see the banks provide lines to lenders like ourselves, or to the private capital groups or PEGs or other investors for which they have just a different accounting practice that they have to set aside reserves for. It's more accretive. The regulators like it a little bit better. Again, they're moving away from the book and hold. And I think that's going to be interesting to see it itself play out. Those investors are really demanding that banks remain accountable to them, but not from a regulatory standpoint, but as a shareholder standpoint. And I will submit to you, at about 4,600 banks today, we could see that number drop to 3,500 in the next 5 years, and maybe down another 10 or 15% after that, because there are just too many banks doing too many things that overlap, and the efficiencies aren't.
Really, probably stupid question, but just going back to when we talk about agency, why do we have Fannie and Freddie? Right? Like,
Freddie,
it's kind of
it's a great question. Fannie was started right after, if you will, the Great Depression. and it was a means to provide, and at the time, exclusively, but single family liquidity to the marketplace. So banks, again, wouldn't have to book and hold these assets. They could transfer them to Fannie Mae. Freddie Mac, interestingly enough, in the 60s was created to create competition for Fannie Mae. And it doesn't get talked about a lot, but that's exactly what we are. The duopoly, if you will, dominated the space because we're competitive Americans. We want to see that one doesn't have exclusive pricing power over the other, and that it is a free marketplace. That's where the two came from. FHA HUD, in speaking, again, they have a huge footprint in the residential VA space. But in the multifamily space, they were created to provide a different form of liquidity, doing longer term fixed rate, doing construction loans, doing AC rehab loans, things that Fannie and Freddie were never actually chartered by Congress to do.
Interesting. Sorry, go David.
You mentioned this, since we're on Fannie and Freddie, talking about it on a high level, the privatization of it. I mean, it's a big concern, or I wouldn't say a concern, but just a big topic of discussion right now, and how that's going to impact the multifamily space. And so I'm curious just to get your thoughts and unpack that as much as you can or willing to. What's that going to do? I mean, especially as it relates to multifamily, and I'm curious also on single family, just because that is the broader housing economy.
They have been in conservatorship for 16 years. Conservatorship at the time, because I was in DC at a subcommittee of Congress, and I think the idea was at the time, Hank Paulson, Neil Kashkari, and others were suggesting that this might be 24 or 36 months until we work through it. In fact, I'll submit to you, they took AIG into corporate conservatorship, and now AIG is back doing just fine, right? But if you were ever, David, to look at too big to fail, it's a housing market in America. And I will submit to you, in the commercial multifamily side, it's just a continuum of housing and multifamily from the single family space. It takes good renters to become potentially good homeowners in the future. So conservatorship was interesting in that it created a continuum of credit, housing, and liquidity. It wasn't broken. And over time, it actually became a toll bridge, if you will, generating lots of income. They've paid back the government 4x over time. So the returns as a taxpayer have been phenomenal in that regard, while still providing that same liquidity to the marketplace. If, however, though, we understand that we are a capital markets society, and capitalism, if it is to rule the day, would submit that perhaps it is time to get them out of conservatorship. It needs to be done in an orderly fashion. I could see it like actually the exit of AIG. The government owns, high level here, 80% of the agencies. They could sell their warrants, their preferreds, and just sell them down over time. The agencies, Fannie and Freddie, were public at one time, so it wouldn't be an IPO, it would be a PO. They would go with a public offering to the market, raise other capital. If we allowed them to continue to build capital, it could be a few years before they would have enough capital to attract investors. But I would be remiss if I suggested that these will be like they were pre-GFC. I think they'll be positively a heavy hand of government, of positive influence to support a stable housing market. And I could see them operating like housing utilities in the space.
But so still some government involvement, just not full conservatorship. And I never thought about it like this, but I mean, if it is providing such a good return, why would the government want to let it go? I mean, why not keep it? And it's running good, and let it go. Is the thought that they'll do more if they kind of had handcuffs taken off and could go? Or, I mean, what's the alternative side of it?
So the decision makers in DC, and there was an act in the first Trump administration that moved forward to closely examining exiting conservatorship, because the private sector can do what the public sector shouldn't do over long periods of time in a more efficient way. That didn't come to fruition, mostly because the end of the term. when Trump did not win and Biden took over. And I think there was a leave well enough alone moment, David, that folks just said, let's not disrupt this. I do believe now, however, though, both for competitive forces and if reframed and perhaps even redefined, I might even say reinvigorated with other capabilities that their charter currently does not allow, they might be able to service more of the public, if you will, through the enterprise designation and delivery of credit support to the marketplace. And that could be very, very positive. Again, I think it's important to know it's not an and or an or. It really should be what is in the best interest of the public, the investing public, the owners of those same shareholders, if you will, companies, and then also those users of those credit enhancement services being, multifamily owners, renters, down to single family owners and owners of single family homes. Because there's a myriad of investors in various parts of the marketplace that take advantage of that same liquidity. And I think that's the reason why you would want to do it, is because it offers greater flexibility and opportunity, while at the same time to be able to say we shrank government, we relieve the taxpayer at some level, although there will likely be an implied guarantee, some level of the tax burden, and we allowed these companies to, quite frankly, do what they've done, but not, I would say, fully enjoyed their ability to innovate and expand products and services.
That makes sense.
What's the negative there? I guess does the marketplace discount that credit enhancement? Does what are the negatives? Because there was a lot of positives there of going to it, but what do you think some of the the flip side of that would be?
If it's not attached to a tax policy, does it have enough energy to make it through? You could do an administrative release, but I think this really needs a legislative release. And would you get, if you will, for lack of a better description, a bipartisan support when they can't even agree that today is Tuesday, March 4th, to do anything that might, if you will, disrupt this? Again, they are generating really good returns for the federal government, I'll say for the Treasury. And it really, we want to do no harm. If I could, Bryan, I would submit to you, in this instance with the agencies, a good nothing is better than a bad something every time. And if they're going to do, as David suggested, the good work that they continue to do, albeit perhaps hampered through regulatory administration by FHFA or whatever the case is, we'd rather not, if you will, kill the goose laying that golden egg. However, with appropriate reform and cap and release, could they do more with appropriately managed, like I said, like a housing utility? So to David's point, there would still be strong governance. I'll call it more oversight than regulatory influence. We might be able to actually even further support housing liquidity, which could lead to more housing units, which could lead to or more refinancing opportunities and more wealth building in this country.
And I don't want to stop this topic, but I do want to make sure, interservice time. I also want to talk about the market before we get off, just because, especially if we're lucky enough that you would agree to come on a kind of a regular basis. I think a lot of people are going to want to kind of hear that, crystal ball prediction. And so I just want to be aware of that at some point.
Yeah, I was going to say the same thing, David. So I think if you can rub your crystal ball and tell us what the next, the future holds, Matt, I'm sure everybody's interested.
I mean, we're looking at, treasuries, last week or so have kind of come down a little, which is optimistic, but it's done that before and kind of got us excited for nothing. And just in general, what are you thinking?
Markets like confidence and predictability, and I will submit to you, we have neither in the marketplace today, as governed by the options market. The VIX for equity is a fear index, and today it's trading in the low 20s, and that's up from 15 about 4 weeks ago. In the bond market, it's called the ICE Move Index, and it's just a measure of volatility in the bond market. In both, I would submit to you, are at extreme levels, but not break glass levels. So I would submit to you that we're in a volatile trading range. And we need to be prepared that there will be uncertainty, political, even unfortunately for the world, geopolitical, with some of the tragic events happening. But we will need, as an economy here domestically in the United States, understand that we're not alone. The tariff, if you will, policies, the tariff diplomacy that was employed at midnight last night is something that will have an impact on certain parts of our economy, if not international economies. And what does that mean? I think awkwardly enough, real estate could become a bit of a favored asset class because of the volatility, as we've seen in equity and some of the debt markets. I'm not going to go ahead and put an S&P 500 pick out there because the trading range is too volatile. I think we could see just wild swings, but I wouldn't be surprised to see us, kind of finish where we started the year. I would submit to you, we started the year with about a 4.5 10-year treasury, and I wouldn't be shocked if it's, a low water mark of 4 and a high water mark of 475. So 435, 4.5 is kind of right in the middle too. I think where the greatest volatility comes is on the short end of the curve, with the 2-year treasury now trading inside of 4%, which is down 30 basis points to Bryan's point in the last 3 weeks. And what does that mean for investors? It tends to suggest, like SOFR at about 433 today, that the Fed funds rate needs to move down from a truly restrictive to semi-restrictive, or I'm not even going to get into neutral because I think that's like finding Bigfoot. We never find neutral in this country, but still come lower. So I would have, probably 2 quarter point FMOC price cuts into the marketplace today, and then you could ask me in the end of Q2, and I'll probably be able to reaffirm or provide other guidance to that. Again, back to the volatility that we've just not seen in markets for an extended period of time, not driven by market conditions per se, but by geopolitical, political, and administrative action.
Matt, can you walk through, they cut Fed funds rate today, right? Like, what does that have to take, though? Because that's not a direct correlation, right, to 5-year treasury, 10-year treasuries we're talking about. So what is it that, that happens? What is the impetus that actually makes a movement in basically the treasury market? Like, what causes that? What's the correlation?
It's a great question. And really over the last few years, I'd be able to answer it much better than I am right now because of this new sense of volatility to the market. And Bryan, just let me get into it. We're issuing a lot of debt, right? I mean, we take in 5 trillion, we take in 3 trillion and spend 5 trillion. That's not good. Reevaluating our commitment to NATO in other foreign investments that we've made over time, which means that debt issuance in those other countries, particularly in the Eurozone, are going to have to go up markedly. So we have our debt issuance that goes up, and worldwide debt issuance goes up by other G8 nations, and it creates supply. So what will be the bid on that supply? Because investors look at treasuries, although it's a no-fail bet from a credit standpoint, you're taking liquidity risk. No credit risk, but liquidity risk. What are your alternates? If we were, however, though, just to look at the Fed and say the Fed is guiding now to, according to the options contracts, 1 or 2 quarter point cuts, you might say, you're right, Bryan, that doesn't have a direct correlation on the 10-year because the 10-year treasury is supposed to be inflation plus about 1.5%. So that's what 10-year investors are really buying into right now. I think we've actually decoupled some of that more traditional investment thinking. In fact, most of the activity that we're doing today isn't 10-year fixed rate loans, it's 5-year loans. People want flexibility. They think interest rates are going to come down. Fund life in commercial real estate, for example, is shorter than 10 years. So they need that flexibility to get out or recapitalize. or have a continuation fund for new investors to come in. So I think those dynamics are I want to be careful. I won't say new paradigm, not divorced from, market realities, but perhaps a bit divergent, more divergent than they have been in the recent history. So I think we'll need to cross that. Well, there are correlated effects to it. One cannot look to say if we had a really aggressive Fed and they cut 100 basis points this year, we would see a precipitous drop in treasuries. I don't think we would, because investors still have other assets to invest in that are higher yielding. In fact, I'll submit to you, if people really want the 10-year treasury to go down to 2.5% or 3% again, be very careful what you ask for, because it means something else is really, really bad.
Sure.
Really good. I guess, and we're coming up on an hour. Matt, this has been amazing. I mean, I think any one of these topics we could have probably expand on for an hour and a half to 2 hours. But, I kind of started, and I want to circle back to it. I think what I've been impressed with, right, in the little bit I've gotten to know you, but everybody I've talked to has spoken about just what a great leader you are, and probably as many great leaders, you probably don't even subscribe that you are a great leader, but kind of what has been some of the formidable things in your life that kind of have shaped your leadership style, and can you kind of define your leadership style, and any advice you would have for those out there, when they're leading other people, what are some of the hallmarks that you look to, kind of like your North Stars in your leadership abilities?
Well, thank you for that, Bryan, and I do appreciate it. But it's only because of the people that are around me. So a great leader knows to surround themselves with great people, and that's a full stop right there. Second, you got to have grit and determination, and you have to be open and aware of changes to yourself, changes to your team, the marketplace, the competitive set, and be willing to really listen to those that offer, I'll call, valuable advice. You're going to get lots of advice. You only need to take the good advice. Learn from your mistakes. Don't be afraid to fail. It's what you do with that information that ultimately makes you a better leader. And then, quite frankly, as simple as it sounds, you got to lead. You got to just tell people, I've been there, I've done that, or I'm going to do this with you as we look at whatever it is, M&A, an acquisition, a disposition of a company, or a servicing portfolio, a large asset pool, whatever that is. You really do need to understand what you're asking others to do and prepared to do it with them. I will also submit to you, though, that don't surround yourself with people just like you. Hire your weaknesses. Make sure you're bringing in diversity of opinion. And I'm talking across the spectrum in diversity. I think what's so remarkable about the human species is that we could sit back and watch the news tonight and say, boy, we do crazy really, really well. And as a species, we sure do. But moreover, if you look at the goodness in people, the drive, the commitment, those that really do want to be those good actors and part of the solution, not in the problem, it's promising. So surround yourself with those same like-minded, those people with perseverance and grit that are willing to listen to you, that can grow with you. But conversely, you can grow from them. You'll learn more from your successes if you've learned first from your failures. And it's understanding what you're good at. And if you're not good at everything, like I'm not, communication, I've struggled with my entire life. I'm an actuary. I like nothing more than sitting in front of a Bloomberg and reading Herfindahl ratings and analysis of different credit spreads and debt, things of that nature. But if I surround myself with some great communicators that we have on our team, it allows me to articulate the message for the company, our team, and those leaders who are empowered that, we're not going to, be here, if you will, to tell you what you do. We're here to support what you do. And we want you to go out and do it. And it's with that support, you should have the trust and confidence that we have your back. But moreover, we're co-pilots in this initiative. So don't think you need to do it.
That's awesome. Yeah. We'll wrap up. I mean, Matt, thank you. I'd love to have you back as often as you'd want to come back. And stuff. We'd like to wrap up with a kind of quick fire lightning round. Most of them are just kind of fun questions, but I'll fire and I'll let David think about it. So if you had to recommend a book to the audience, what would be one book that you would tell them to read?
Oh boy. So I don't read fiction. So I would, Benjamin Graham, Economy 101 would be a good one. And it's The Advent of Capitalism. I think is a very interesting read. And then it would be, quite frankly, I would encourage your readers not what I have read because it's probably going to be very boring and technical, but instead what you could read about what's important for you and your journey, and really, take heart in what you're reading and try to put it into practice and hold yourself accountable.
It's awesome.
What was your favorite thing to do when you were going to Alabama? I saw that's where you graduated.
Oh my goodness. Hey, listen, David, in college, there's not much not to like. Okay, there you go. But it was meeting people, and I listen. I wasn't the talker. I wasn't the big partier, and I wouldn't. But I talked and partied and had a great time and visited with great people. And I'll never forget. It was in a postgraduate class. I was with somebody once, and everybody's kind of stating these things. And some people are going to go to law school, and some people are going to go to business school, and all these other things. I talked to this one person, and she said, "Matthew, I grew up with nothing. Like I had nothing. My dad was in the military. Unfortunately, was killed in action, and my mom had to raise three kids by herself. And unfortunately, we don't do a good enough job taking care of our veterans. So, David, thank you and your family and friends for the service that you did in the Marines for this country. But I really do mean that." So when I was talking with her and she said she wanted to accomplish all this goals, she said, "I really, really want to be successful." And I said, "Well, don't equivocate success with wealth because you said you want to go out and make lots of money, whatever. I equivocate success with happiness." And this was fun at Alabama because there's a lot of happy that goes on in university these days. And I said, "Well, how are you going to do that?" And she said, "I am going to hang around rich people, David." In no joke, she had grit, determination, and she told me, coming from nothing, living in subsidized housing, that if she hung around with the right people at the university, got into the right social circles, she could build upon that social capital, which would become professional capital over time, and she'd ultimately achieve the success that she wanted to, which at the end, she admitted, was being happy and being able to, support her family.
That's a good story. I like that.
Yeah.
I asked my cousin went to Alabama and played football there, so I was noticing when people go there.
What's would you recommend for the commercial real estate folks that are listening, which I would imagine would probably be most people listening? What's one thing you would have them read every day? I know you talked about. I know you stay on top of the news, Bloomberg, whatever. Is there anything that you would say, hey, these are the things that you should kind of keep up with every day?
I'd be careful not to distract yourself with too many. So you pick your few. If you're able to have access to real estate alert or commercial mortgage alert, it's a quick tabloid, and it's very good in that regard. I still think old fashioned the Wall Street Journal is important. It's less about real estate, although there is a Wednesday commercial real estate section, but more about other things that drive real estate. Remember, real estate, as we said earlier, is an important diversifier to an investment portfolio. So it's understanding what those returns offer in other investment portfolios that are both your friend and foe, perhaps competition, or perhaps something that supports you in your endeavors in commercial real estate. And then, old fashioned Financial Times and Bloomberg. You really just get down to fast pace. I don't want to read a long article. I want something short, to the point, which will get me up to speed. But I will never discount the value at times, and it perhaps it's monthly, but picking up information, for example, prepared by Colliers Valuation, information prepared by economists of any sort, and just reading a perspective that they have, taking that information, adding it to the diversity of other pieces of information that you've received, and then formulating your own opinions. And if you're not comfortable doing that as a practitioner in the space, to all you real estate owners, investors, and practitioners, reach out and talk to somebody. I've never seen, Bryan, an industry more collaborative and supportive, not just of the senior executive peer leaders, but the next generation of high performers willing to help, encourage, and support folks to be successful. And it doesn't matter, what name badge you have or anything else. This industry is fantastic, and I encourage people to be involved. Use that social capital that you have at your existing company and build upon it through your network, through the real estate industry. Trade groups do that, industry organization, outreach efforts. Just, make sure that, you happen to yourself, because otherwise it will happen to you. So if you want that outcome to be ultimately what you've planned in your personal business plan, you got to make sure you have the grit and determination to go out and make that happen.
That advice, and I know David and I probably echo, like, is so valuable, and I think so few people actually follow it. I mean, David and I do some national coaching, and we get to see people from a wide variety of brokerage shops, and we'll be on calls, and the ones that break down the fact that, like, I don't want to share that, or that have the scarcity mindset, right, are never as successful as those that have the growth and the abundance mindset and want to give back. I think that's an amazing advice. So
yeah. No, it's a great way to wrap it up. And so
I think, Matt, did we lose you?
No.
Oh, we lost your video, but we got the audio. I guess we'll ask you the last question to wrap up is, what do you do for fun when you're not reading Bloomberg, Financial Times, and Economist magazines? So.
Okay, here we go. I spend time with my family. I married my best friend, and we've been married now coming up on 30 years, which is great. And with our 3 adult kids, fishing, hunting, boating, whatever is out there that I can have a good time and just spend it with people I love. That's what I enjoy most.
You just named my 3 favorite things: fishing, boating, and hunting.
Well, Matt, it's you've been very good with your time. I know we ran over, so thank you very much. And really appreciate it.
Well, I look forward to the next